Israel Investment Advisors First Quarter 2025 Newsletter. The Israel Investment Fund LP, Our Investment Approach. I'm Brian Friedman. Although military and geopolitical news captured much of our attention since Israel's multi-front war began on October 7, 2023, we did not deviate from our underlying investment philosophy. After 18 months of war, we want to reiterate our approach to investing in the Israeli stock market. Below, we outline the elements of our approach that rely on universal investment concepts, and then those elements unique to the Israeli context. Universal principles of investing. The intrinsic value of any business or asset is the present value of future cash flows. Present value reflects the principle that money is worth more today than the same amount of money in the future. Present value adds up all expected cash flows in the future and then discounts these cash flows by a rate of return reflective of time, anticipated inflation, opportunity costs, and assessments of risk. Since future cash flows and risks are very difficult to predict, analysts use shorthand ratios such as price to earnings, PE, to gauge company valuation. A higher PE ratio often implies faster growth expectations or less perceived risk, while lower values reflect the opposite. Ironically, when valuation ratios reach extremes, particularly on the euphoric high side, the future often turns out to be the opposite of the expectation. Another commonly used ratio is EV over EBITDA. Enterprise value, EV, is the stock market value of a company plus its total debt outstanding. Think of a company as a whole pie divided into equity and debt slices. Earnings before interest, taxes, depreciation, and amortization, EBITDA, is a broad measure of cash flow that is sliced and dished out to pay bondholders, governments, and shareholders. EV over EBITDA allows comparisons among companies with disparate debt levels, tax regimes, and accounting standards. Table 1, included in the attached PDF, compares the enterprise value to EBITDA ratio for the Tel Aviv 125 index to the S&P 500 index in the US. Over the past decade, earnings per share grew 7% per year for the S&P 500 index and 8.2% per year for the Tel Aviv 125 index. Although both numbers are quite robust, Israeli companies nonetheless grew a bit faster than their American counterparts. Despite faster growth, Chart 1 shows that Israeli enterprise value to EBITDA ratios are consistently below their American peers. Faster growth with lower valuations indicates risk perceptions are higher for Israeli companies. In the United States, smaller companies tend to sell for lower enterprise value to EBITDA ratios. For example, at the end of 2024, the enterprise value to EBITDA ratio for the S&P small cap 600 index was 12.1 compared to 16.5 for the very large companies inside the S&P 500 index. The Israeli stock market is comprised of smaller companies like the S&P small cap 600 index, but the enterprise value to EBITDA ratio of the Tel Aviv 125 index was just 8.7 at the end of 2024. Comparing balance sheets yields similar results. The debt to asset ratio, which measures how much of a company's assets are financed by debt for the Tel Aviv 125 index, is a very low 16.9%, while the same ratio for the S&P small cap 600 and the S&P 500 indexes is 23.4% and 26.7% respectively. Our approach to investing, whether in Israel, the United States, or any other country, is to buy profitable companies with strong balance sheets at reasonable valuations. In Israel, these types of companies are substantially less expensive than in the United States. Elements unique to Israel. From its pre-state foundations until the 1990s, Israel was a small socialist economy monopolized by companies owned by the government and the Histadrut labor union. The economy was privatized in the 1990s and early 2000s, but retained its highly concentrated structure. When the Second Intifada ended in 2005, Israel launched a profound economic restructuring, reminiscent of early 20th century trust busting in the United States. Israel did not fully open markets to intense competition. Rather, it adopted an evolutionary approach. For example, until 2005, Israel's three largest banks controlled almost every financial transaction in the country, including deposits, loans, payments, securities, pensions, and asset management. In 2005, the Israeli government forced the banks to sell their capital markets activities to the 6 Israeli insurance companies. This did not throw the gates wide open to financial competition, but it did enable insurance companies and banks to compete against each other in a variety of ways. At the same time, Israel revamped its savings and pension systems. The system is based on tax-advantaged retirement plans, but with government-mandated contributions from employers and employees. Israel now has the highest savings rate in the developed world, and Israelis are amassing financial wealth at a rapid clip. The Israeli government publishes gross savings data rather than the commonly reported personal savings rate published by the United States government. Gross savings includes household savings, business retained earnings, government savings or deficit, and income on foreign assets. In Israel, gross savings is 27% of GDP versus 17% in the United States. Layered on top of these reforms is Israel's rapid population growth. When Israel declared independence in 1948, there were only 600,000 Israelis. Israel fought the Yom Kippur War in 1973 with a population of only 3 million. Today, Israel is a developed country of 10 million people. Trust-busting reforms increasingly channel capital away from incumbent companies toward competitors. Although losing market share, incumbents are nonetheless still growing because Israel's economy is expanding. Additionally, intensifying competition is forcing incumbents towards greater efficiency. See Chart 1 on the attached PDF, highlighting one aspect of rising productivity at Bank Hapoalim, Israel's second largest bank. We dub this evolution scale-up nation. Israel's economy is evolving toward deconcentration and competition while benefiting from improved economies of scale. For shareholders, this creates a combination of dynamism and business stability unique in the world. We focus on business fundamentals. Assessing risk is complicated, but security concerns must certainly contribute to Israel's substantial valuation discounts to the U.S. These concerns are valid, given the Hamas surprise attack on October 7, 2023, and the ongoing multi-front war. Despite these valid concerns, we nonetheless believe global investors undervalue Israeli stocks given the scale-up nation dynamics outlined above. Perhaps that is why military success played such a critical role in Israel's stock market recovery last year. Our approach in the Israel Investment Fund LP is to focus on the scale-up nation business fundamentals while retaining confidence that Israel will continue to successfully defend itself when necessary.